capital structure theories. What is this capital structure theories? As we all seen that capital structure means broadly equity plus debt. Now the issue is whether debt financing in the capital structure is good, whether introduction of debt has any positive impact on the firm. As you all know, the object of finance management is value maximization. Value maximization means the value of the firm should be more. All decisions that a finance manager or the company takes must result in the appreciation in the value of the share, thereby the market capitalization of the firm. Market capitalization, I mean the number of shares into market price per share. So, why we should think like that? What is the difference between sources of finance, equity and debt? We have already discussed. In case of equity shares, we need not pay dividends if there are no profits. And there is no obligation to repay the capital, the principal sum. But in the case of debt finance, it's not like that. We find that the interest must be paid whether the company makes profit or not. And when you take the debentures, you promise to redeem them, repay them after say after 5 years. So therefore, we must have funds to repay them, otherwise you will be in soup. So therefore, to that extent, debentures are risk. The cost of debentures, as we saw, is much lesser than the equity. We have already discussed in the initial topic. Coming to the issue here is it's a theory. Totally we are assuming certain things and then we are trying to argue on that. Whether the introduction of capital structure theory means what? Whether the introduction of debt has any impact on the valuation of the firm. Is capital structure relevant for valuation of the firm? This is the question. We have before you two theories. Some of them believe yes, introduction of debt has a positive impact on the value of the firm, and another thing is no, introduction of debt has no impact on the valuation of the firm. So let us see that yes theories. Yes theories comprises of net income approach and then traditional theory, which is also known as middle of the road approach. No theories, that is net operating income approach and then Modigliani-Miller's approach. So coming to the subject, what is the significance of debt? Let me explain you. I have to show you that introduction of debt will increase the return on equity. At the same time, it will also have a risk element introduced into the system. So we have to balance between the risk and return. That is why debt finance is risky. We will have to think. There is a benefit is there, that is in the form of cheaper source. Debt is a cheaper source of finance. But there is a disadvantage because debt is risky. This is amply explained in this example. See this simple example, funds required is 50 lakhs to do a project. The rate of EBIT is 30%, tax is 30%. And the company can get the finance won by equity share capital alone, 50 lakhs. Or they can go for mix of equity and debt, 20,000 equity shares of 100 each plus 30 lakhs worth of debentures. Now, you can see in alternative 1, the earnings after tax is 10,50,000 only on account of the equity finance. Rate of equity, return on equity is 21%. Whereas alternative 2 as a debt component, and you find the return on investment is 40% equity. So this example will clearly tell us that introduction of debt will definitely improve the return on equity. So you observe that introducing that you have financed the entire capital through equity, your return on equity is just 21%. With all the conditions being the same, introducing debt into the picture, your return on equity has gone up to 40%. So therefore, there is an advantage because of debt. Now let us see a situation. What is risk? How do you say debt is risky? Then let us see if the EBIT falls by 30% from the present level. If the EBIT rate falls by earnings fall by that 30%, what will happen? You will realize that you see the next statement that it is coming down to 14.7%, 24.15. And you will see the rate of fall is in case of equity financing. When the rate of EBIT falls by 30%, you will find that the return on equity also falls by the same percentage. But in case of debt financing, the return on equity falls by 40%. So that shows that the risk element is there in the alternative too. So now we have answered the question that debt is benefit is there because of debt, and at the same time there is also disadvantage is there because of the debt. Now, what is that theories are trying to say? Net income approach assumes that the introduction of debt has a positive impact on the valuation of the firm. That means more debt, more good. That is what we are going to show with example. But before we go into the picture, we have to understand the valuations, symbols and all. The value of a firm is equal to VO. The value of a firm is denoted by VO. That is equal to value of equity, VE, plus value of debt, VD. Now, I have taken 1 lakh rupees loan. I am paying 12% interest. So I have to pay an interest of 12,000. So that 1 lakh is called as value of debt, VD, into KD, cost of debt, VD into KD is equal to I. VD, value of debt, into cost of debt is equal to interest. So therefore, value of debt VD is equal to I divided by KD. I divided by KD. Very simple. In the same manner, value of equity VE into KE, cost of equity, is equal to EAT, earnings after tax, PAT, PAT, profit after tax, both are same. Therefore, value of equity is equal to EAT, earnings after tax divided by VE. So therefore, VO, value of the firm, is equal to VE plus VD. This is the subject. Now we are going to see how the debt has got an influence. These are the equations I put before you, friends, in a very simple manner you can understand. Coming to this problem, how to prove that more debt is more good according to this theory. Equity share capital is 1,50,000, 1,50,000. 12%, 6% debt is 50,000, 1 lakh, 150. So the total value of the firm is 2 lakhs, 2 lakhs, 2 lakhs. KD is 6%, KE is 10% fixed. So in this problem, we find there are 3 firms whose capital structure debt proportion is increasing. But the cost of debt and cost of equity remain constant, no change. So take the firm A. Earnings before interest and tax as 30,000, interest at 6% 3,000, so E80 is 27,000. Value of debt is equal to I by KD, that is equal to 3,000 by 0.06, 50,000. Similarly, the value of equity is E80 by KE, that is 2,70,000. 60 plus 2 lakhs, 50 plus 270 is equal to the value of the firm 3,20,000. KO, that is overall cost of capital, is earnings after tax divided by KE, that is coming to 9.38%. 9.38%. So friends, when you compare the valuation for all the three firms, you realize as the debt is increasing, you find the value of the firm has gone up from 320, 340, 360. Or inversely, the cost of capital is falling. Weighted average cost of capital is 9.38, 8.88 and 8.33. So that is how the theory is proved. This theory does not take into consideration the taxes. Assume that taxes are absent. So I have put a chart to explain this point. You find as the proportion of debt and equity are increasing in the capital structure, x-axis, you find KE and KD are constants, and KE is higher than KD, and the value of KO starts falling. The weighted average cost of capital starts declining. So in other words, because the debt is cheaper source. Suppose 6% you are earning a cost, whereas you are earning 20%. So that 14% there is a benefit which will go to the equity shareholders. So therefore the value of the firm starts falling down. That is what is explaining this problem. Fine. Now we are going to the next theory, that is same. This theory believes that introduction of debt has a positive impact on the valuation of the firm. But theory 1, net income approach, believes more debt, more good. But in practice, nobody finances their capital through debt finance. So therefore, this theory believes in optimum capital structure. That is, initial stages introduction of debt is good. It will have a positive impact on the valuation of the firm. But as the proportion of debt increases in the capital structure, both the risk perceptions of equity as well as debt holders will increase. Because more and more debt funds coming, the equity shareholders' money available will fall, profit available, and they are more risky, and therefore their risk perceptions is increased. Then naturally expect the cost of capital, cost of equity to go up. So what happens is, as the proportion of funds increases, both the costs are increasing. Net result is, you can see in the problem that we have explained, that the cost of capital starts decreasing, reaches a point, and then will increase. So therefore this theory believes in the optimal capital structure. You will notice that this graph is of two parts I have given. A perpendicular x-axis OX I have drawn, and below that value of the firm, above that cost we have taken. You will notice that KD and KE are increasing in slabs, range bound behavior, and KO is falling, reaching minimum and then increasing. So VO is maximum and KO is minimum. So that's what I have explained in the problem. You find that optimal capital structure is 30% debt and 70% equity. So now we are going to discuss the net income, net operating, no theories. The no theories believe in that the risk capital structure is irrelevant for the valuation of the firm. The value of a firm will be driven by the expected return. The expected return will be driven by risk perceptions. Suppose all things are equal and we have two firms which belong to same risk class, then naturally we expect same return. When you want to deposit money in two banks, both of them are giving only same rate of return, 10%. That is because the risk is same in both banks. So therefore, this theory assumes the risk arises not because of the project risk and not how the funds have been financed. Take for example, I have got 100 crores. If I put that 100 crores in a real estate business, fairly you will get some money, no problems. Whereas if you want to produce a film or you want to go for a horse races, then the risk is very high. So therefore you expect high return because any time you will get wiped out. So therefore this theory logically believes that introduction of debt has no relevance because the risk arises because of investment. And if you are increasing debt, naturally the amount of profit available to the equity shareholders will get reduced. Therefore, equity shareholders' risk will increase and not the value of the firm. So, if firms belong to same risk class, they are expected to earn same return. If they if they earn the same return, the value of the firm will be same. That is the logic behind this theory. So, you see the graph. The value of KD and KO are constants. When KO is constant, naturally the value of the firm will remain constant. And we see that as the proportion of debt increases, you find QE is increasing. Therefore, I tried to explain you with this problem that there are firms, three firms are there, ABC, earning same return, EBIT 30,000, but the capital structure is different. We find that first step is value of the firm is 3 lakhs and value of the debt is 50,000. Therefore, value of equity is 3 lakhs minus 50,000, that's 2 lakh 50,000. And you find KE is 10.8. So you will notice that as the proportion of debt increases, the cost of equity is increasing. Thus this theory stands proved. So now we are going to take up discussion on Modigliani-Miller's theory. This theory also believes that the capital structure is irrelevant for the valuation of the firm. He says that the value of a firm cannot be different if everything is same, all the things being equal, that is risk class is same, it cannot be same, different. This principle is based on arbitrage theory. What is arbitrage? See, a computer is available in Chennai at 15,000 rupees. The same computer is available in Bangalore at 10,000 rupees. So what you will do? The computer is available in Chennai at 15, whereas in Bangalore at 10. So you may answer that you will buy it in Bangalore because it is 10,000. But the real answer is, I will buy in Bangalore and sell it in Chennai. Because there is a price difference, giving an opportunity for sure profit. So that is called as arbitrage. That means same commodity is traded in two markets, Chennai and Bangalore. And there is a price difference. And one can buy or sell in both the markets. There is no barriers. Then the transportation costs are not there, negligible assumption. So you will buy it low and sell it high. This process of buying and selling will continue so long as the prices reach equilibrium. That is called as arbitrage theory. In this problem also, in this theory also says that, okay, you are saying firm A, firm B, both are belonging to same risk class. But they belong to different risk, they have different market prices. That is what you are trying to argue. The one which is having more debt will have better market price. Levered firms. Levered firm means that the firm has some debt in its capital structure. So, in this scenario, what happens is, suppose for example a levered firm is valued at 2 rupees per share, whereas unlevered firm without any debt is valued at say 1 rupee. If you are a shareholder of a company, a levered company, unlevered company, you better sell it. That is, if you are in the unlevered company, levered company, suppose you are a shareholder of a levered company, that is the company which has got a debt. So it is priced high, therefore it is better you sell off and then shift it to the unlevered company. So therefore, these movements will start once there is a price difference, there is a scope for arbitrage, and the people will start buying and selling in place, and this will automatically bring the prices to equilibrium. Therefore, this theory believes that there cannot be different valuations. Theory, as you know, that makes a lot of assumptions. That's what we are going to see. Now we are taking this point, and there are a lot of assumptions given in these things. Modigliani-Miller's approach. Take this problem. Firm A, firm B, and firm A, EBIT is 18,000 rupees, and firm B is 18,000, same. Equity capital 1,50,000, 1 rupee per share, face value 90,000, and debt is 60,000 in firm B. So firm B is called as a levered firm. Firm A is called as unlevered firm. So suppose, for example, firm B's value high, then we are going to prove that it will be advantageous for a shareholder of B, unlevered firm, to switch over to unlevered firm. What are the assumptions? First step, it is possible to classify the firms according to same risk class. 2, the capital markets are perfect. That means nobody is going to influence the market, and no single individual or single party can influence. No, there are no barriers. There are no barriers. That means you can transact in both the markets. There are no transactionary costs. There are no transactionary costs. That is, you sell or buy, there are no charges. And there are no taxes, corporate as well as personal taxes. And another important point is the entire earnings, anything left over, will be paid to the equity shareholders. This is the issue. So now, as per this problem, I am an equity shareholder holding 9,000 shares in firm B. So, first step 1, I will sell it. So selling means I will get 10,800, 9,000 into 1.2, 10,800, fine. There are no transaction costs, there are no corporate taxes, so entire money will come to me. But friends, one important point is here, you are a shareholder in a firm B, which has a debt for the company itself. So that means there is some risk is there in case of a levered firm. From there you are shifting to firm A. From there you are shifting to firm A. This is unlevered firm. This is unlevered firm. That means there is no risk. So comparison becomes difficult. When you are moving from a risky company, you are already exposed to some risk, but the risk is with the company. You are going to another company where there is no risk for the company. How will you compare it? Therefore, you create a personal loan, personal debt. You create a risk so that it is comparable. Now you see that you are holding 9,000 shares, which is equal to 10% interest. 90,000 shares the total, in that you are holding 9,000 shares. That means 9,000 by 90,000 is 10% interest. So you have to create 10% debt also, leverage. 10% of 60,000 is 6,000. So 9,000 is 10,800 I have got because of the sale. Plus I created my own leverage, 6,000. So I have now got 16,800. So here the Modiglani makes an assumption which says that the shareholder will be able to borrow at the same rate and at the same cost as that of the company. So here we notice that he say borrow 6,000. Why he is doing? He is going from a risk class and to an unrisked class. So comparison becomes difficult, and therefore we will have to create a personal leverage. That is the reason. So now when you compare, dear friends, you will find you have got 16,800 rupees with you. With that you can buy 16,800 shares. That means your controlling interest is 11.2. In other words, by switching over 10% stake, you are able to acquire 11.2% stake. So, let us compare what is the benefit of doing this. You are now in the unlevered company, and the unlevered company is made a profit of 80,000. As you know, the assumption is the entire earnings will be distributed as dividends, and therefore 11.2% into 18,000, that is 2016. Less 6% interest on 6,000 that I have borrowed, that is 360. Here if you must notice the retail, that is personal leverage 360, 2016. So 1650 is 1656 will be net surplus with you. But because you are shifting from a unlevered company to a levered company to an unlevered company, debt company to a no debt company, then you are losing something. What is that? That if you had stayed in company P, you got 18,000, less interest of 3,600 payable by the company. EBT is 14,400. 10% dividend is 1,440. So by doing this, you are in a position to make surplus of 216. That is, there is a scope for arbitrage. So every shareholder of the levered company would prefer to sell their holding and go to the unlevered company. This process of buying and selling will, if you keep buying, the price will increase. If you keep selling, the price will fall. Therefore, it will come to equilibrium. That is according to Modiglani and Miller. The companies cannot have different valuations merely because of the operation of arbitrage. That's all. These are the capital structure theories that we have taken up for discussion.